That is the question. Which story does Flipkart tell investors? Are they a profitable, mature retailer? Or are they an aggressive, high-growth ecosystem that's ready to dominate the entire future of Indian commerce? The strategy they pick right now, just before the big billion-day sale, isn't just going to define their next quarter. It's going to write the very first, and probably the most important, chapter of their life as a public company. So, what would you choose? All right, welcome to The Explainer. Today we're diving into Flipkart, the e-commerce titan that's staring down a massive IPO and a billion-dollar choice it has to make, like right now. And it all boils down to this one question that's keeping the leadership team up at night: power law bets or unit-level discipline? It's a single decision, that could literally define their entire future. So, picture this. You're in a high-tech war room in Bengaluru. The walls are just covered in glowing data dashboards. There's a digital clock on the wall ticking down to India's biggest online sale, and the team is intensely debating these tiny little changes that could swing profits by millions of dollars. The pressure is on, big time, because their massive annual sale, the big billion days, is just around the corner. Okay, but here's the thing. This isn't just about one big sale. No way. This is about the story Flipkart is about to tell Wall Street and to Wall Street. We're talking about a huge IPO on the horizon, one that could value the company at over $37 billion. So yeah, the stakes are massive. Now, to really get what's at stake here, you kind of have to look at how they got here. I mean, Flipkart's journey has been an absolute masterclass in aggressive scaling. They started as a simple online bookstore, founded by a couple of ex-Amazon guys, and just exploded from there, buying up companies and pulling in massive funding, all leading up to that landmark deal with Walmart. And this number, wow, this is what creates all the pressure. When you hit a peak valuation of nearly $38 billion, the path to going public becomes incredibly high stakes. They have to prove to a whole new set of investors that they're still worth every penny and then some. And make no mistake, the IPO countdown has officially started. They're doing this huge, complex thing called redomiciling, basically moving their legal home base from Singapore back to India. It's a clear signal, right? It's expensive, it's complicated, and it puts every single strategic move they make under an intense microscope. So why all this pressure? Well, because Flipkart isn't operating in some kind of bubble. Not at all. It's fighting a full-on war on multiple fronts in one of the most competitive e-commerce markets on the planet. Just look at the battlefield. You've got the global titan, Amazon, with its unstoppable Prime ecosystem. Then there's Meesho, this super aggressive disruptor with a zero-commission model that's just crushing it with price-sensitive shoppers. And you can never ever count out Reliance, which is brilliantly blending its huge network of physical stores with its online presence. But there's a new threat, a whole new player that's changing the game completely. And that threat is quick commerce. Yeah, we're talking about players like Blinkit and Zepto, and they have completely rewired what we as consumers expect. We're not talking about waiting for days anymore. We're talking about getting stuff in minutes. It's a total shift from that old centralized warehouse model to this dense web of local dark stores that are built for one thing, and one thing only: pure, unadulterated speed. And this is a massive problem for a company like Flipkart. See? Quick commerce is swooping in and stealing all those small, frequent impulse buys. The groceries, the snacks, the very things that build a daily habit with a customer. It risks turning platforms like Flipkart into a place you only visit for occasional, big-ticket items, and that makes them way less relevant in your day-to-day life. So, that brings us to the decision. Flipkart's leadership team is staring at 3 very different paths forward, and they have to pick one, right now, before their biggest sale of the year kicks off. Okay, path number 1. Let's call this tighten the screws. It's all about discipline. They could raise the minimum amount you have to spend to get free shipping. The goal? Make every single order more profitable and get rid of those small money-losing baskets. But the risk is huge, right? You could easily tick off your price-sensitive customers who will just hop over to a competitor without a second thought. And this chart, it lays out that trade-off perfectly. The data here, though illustrative, shows that even if you lose a few sales, bumping up that shipping threshold could seriously boost your contribution margin. And trust me, that's a metric that IPO investors are going to be looking at with a magnifying glass. All right, what's path number 2? It's simple. double down on what's already a massive profit engine for them: advertising. They could cram more ad space onto the platform, push their own in-house brands more, and basically use all that high-margin ad money to pay for their expensive delivery business. The danger, of course, is that you end up with a cluttered, annoying website that just drives shoppers away. And we're not talking about some small side hustle here. This is serious money. We're talking ad revenue in the neighborhood of 5,000 crore rupees. That's over $600 million in just 1 year. Retail media has become this incredibly powerful force that can literally fund their other big risky bet. Okay, so what's the third path? This one's a bit more conservative. The idea is to protect the core. Focus on what's already profitable for them: mobiles, fashion, and be way more careful with the cash-burning experiments, like quick commerce. Maybe they just test it out in a few big cities. It's definitely the safer route, but it comes with its own risk. You could end up looking stagnant to investors. And worse, just hand over the fastest growing part of the market to your rivals. So all three of these paths, they all lead back to the same fundamental question. It's a classic business dilemma, one that almost every major company has to face at some point. Do you chase aggressive growth, or do you lock in stable profits? Now, to make a decision this big, Flipkart's leadership isn't just, throwing darts at a board. They're using these really rigorous frameworks, like something called innovation accounting, to run controlled experiments. They're trying to separate the real signals from all the noise, to figure out what's actually working before they go all in and commit billions of dollars. And you can feel that internal push. The CEO himself has said they're getting close to profitability, mainly by cutting down on how much cash they're burning every month. That's a clear signal. But the pull from the market, that demand for explosive, game-changing growth, that's just as strong. So here's what it all boils down to. This is the core takeaway. It's this timeless battle, right? Do you secure your profitability now so you look stable and predictable for your big IPO debut? Or do you pour that money into a really uncertain, but potentially way bigger future, just to make sure you don't get left behind? And ultimately, that is the question. Which story does Flipkart tell investors? Are they a profitable, mature retailer? Or are they an aggressive, high-growth ecosystem that's ready to dominate the entire future of Indian commerce? The strategy they pick right now, just before the big billion-day sale, isn't just going to define their next quarter. It's going to write the very first, and probably the most important, chapter of their life as a public company. So, what would you choose?